An Accounting 260 video on closing the books. So this semester was a little hurried. So what I'm going to do is I'm going to teach you the closing the books process via video. It's really not too hard. All you have to do is pay attention and watch it as many times as you need to watch it. Okay, so I'm going to share now the content of a Word document with you. Okay, so we have posted certain general ledger accounts, as you can see. We've made certain entries for the year ended 12/31, December 31st, 2021. And now we're ready to close the books, close the accounts. So these are all the general ledger postings that we have for a year. And what we want to do is now we want to close the expense and revenue accounts. Those are called temporary accounts. And the reason they're called temporary accounts is that they're closed every year and restarted. So what you're concentrating on here are these accounts. In this case, we have machine sales revenue, your revenue accounts, your part sales revenue accounts, and all your expense accounts. So we're taking account these accounts right here from revenue on down. So machine sales revenue, part sales revenue, cost of goods sold, salary and wages expense, rent expense, utility expense, depreciation expense, insurance expense, and employee benefits expense. These are the accounts that are affected when you close the books. Again, you're zeroing out all the revenue accounts and all the expense accounts. So the next thing we go is we get a fresh journal entry in our general journal. And we start closing out the accounts. How we close out the accounts? Well, for example, our revenue accounts are credits. Machine shop sales revenue is a credit because revenue is on the right side of the accounting equation, and everything on the right side of the accounting equation has a credit. And part sales revenue is also a credit. To zero that out, we want to debit it. And the offsetting account is a made-up account called income summary. So I took the $1,000 that is in the machine. I took the $1,000 as a credit, $1 million as a credit, the machine sales revenue, and I'm debiting that same account for the same amount, except I'm debiting it instead of crediting it. Part sales revenues has 550,000, that's a credit. So I'm gonna debit it instead of crediting it. And now I'm gonna post that journal entry to the general ledger like I always do. Okay, so I have a credit balance here. Remember, part sales revenues is on the right side of the accounting equation, and everything on the right side of the accounting equation has a credit balance, a normal credit balance. I am debiting it for 550. So that means that there's going to be nothing left in the account. I am zeroing out the account. Same thing with machine sales revenue. So machine sales revenue is also a revenue account. And like all revenue accounts, it's on the right side of the accounting equation. The right side of the accounting equation has credit to increase and debit to decrease, and a normal balance of a credit. I'm going to debit the account, zero it out. And you see this account called income summary? That's an account I created just for the close process. So I zeroed out all the revenue accounts. There was no revenue anymore, and essentially put it in this income summary account. By doing a journal entry. The same thing is done with the expenses. So what I do is the expenses all have debit balances because expenses are on the left side of the accounting equation, and the left side of the account, everything on the left side of the accounting equation is debit to increase and credit to decrease. So all these expenses have a debit balance. I need to zero those out. Again, the offsetting entry is to income summary. So the first account is called cost of goods sold. And that has $600,000 in it. That's a debit. So I'm going to credit cost of goods sold for the entire $600,000. The next account is salary and wages expense. It has $250,000 in it. There's a debit right now, so I'm going to credit it. The next account is rent expense. Rent expense has $120,000 in it. It's a debit, so I'm going to credit it to zero it out. Next one is utilities expense. Utilities expense has $6,000 in it. Again, I'm going to credit it to zero it out. The next account is depreciation expense. It has $10,000 in it. The next account is insurance expense. Insurance expense has $12,000 in it. And the last one is employee benefits expense. Employee benefits expense has $17,000 in it. Income summary, then I just total these all up and I debit income summary for all the amounts that I credited. Now I post that journal entry to the general ledger. So the first one I'm going to do is income summary. This is a debit. And then I'm going to credit all the expense accounts that I made this journal entry for. So I'm going to credit cost of goods sold for $600,000. Just like I did in the journal entry. And then I'm going to credit salary and wages expense for $250,000, just like I did in the journal entry. And I'm going to zero it out. That's why I'm putting none, because the balance in the account is zero. By zero, I mean there are $250,000 worth of debits and $250,000 worth of credits. In the cost of goods sold account, there are $600,000 worth of debits and $600,000 worth of credits. The rent expense account has $120,000 in it. I credited that for $120,000. So just like I did in the journal entry, I'm going to record that in the general ledger. So again, there's $120,000 worth of debits. There's the $120,000 worth of credits, so there's no balance. Utilities expense. I made a $6,000 credit entry into the utilities expense. And again, that's zero the account out. By zeroing the account out, I mean the debits equal the credits. There are $6,000 worth of debits and there's $6,000 worth of credits. So the account has no balance in it. Depreciation expense was credited for $10,000. Again, there's $10,000 worth of debits and $10,000 worth of credits, but there's no balance. Insurance expense was credited for $12,000. An employee benefits expense was credited for 17,000. So as you can see, what we did was we simply credited the accounts that had a debit balance and debited the accounts that have a credit balance, so that there is no balance in the accounts. $17,000 debit, $17,000 credit, $12,000 debit, $12,000 credit, $10,000 debit, $10,000 credit, $6,000 debit, $6,000 credit, $120,000 debit, $120,000 credit, $250,000 debit, $250,000 credit, $600,000 debit, $600,000 credit, equals no balance. The last part of this is closing out the retained earnings account, the income summary account to retained earnings. The balance in the income summary account gets zeroed out, just like all those other accounts got zeroed out. And the balance goes to retained earnings, which remains open. So the balance right now in the income summary account, we look at the income summary account, it has a balance of 535,000, the difference between the 1,550,000 credits and the 1,015,000 debits. And we're going to, since my credits are higher than my debits, we're going to debit this for $530,000. And now this account has no balance. The credits or retained earnings get posted to the retained earnings account. And the balance gets adjusted to 2,135,000. So that's the entire close process. We create a journal entry to close out all your revenue accounts. By debiting all your revenue accounts and crediting an account called income summary. All these revenue accounts have a credit, so you want to debit them so that they become zero. Then you do the same thing with the expense accounts in the second journal. I usually do it as separate journal entries just to make it easier to understand for lesson purposes, just to make it easier to understand. So we're crediting all these expense accounts because they have debit balances. And the offsetting balance goes to the income summary account. And then the last part of this is the balance in the income summary account goes to retained earnings. We zero out income summary account. And we post it to retained earnings. So I'll let you look at the process again. We took the trial balance and each one of the revenue accounts has a credit balance. So we're going to debit them in the first entry. And the offsetting credit is going to be an account called income summary. We do the same thing with the expense accounts. We take the balance, the debit balance, and we credit it. And again, the offsetting debit is income summary. 600. Cost of goods sold is 600. Salary and wages. 250. Rent. Utilities. Appreciation. Insurance expense. And employee benefits. As you already know, these amounts came from the general ledger. Employee benefits expense came from this part of the general ledger account, employee benefits expense. Insurance expense came from this part of the insurance expense account. Depreciation expense came from this part of the depreciation expense account before we zero it out, is what I'm saying. Utilities expense before we closed it out, zeroed it out. Rent expense before we closed it out. Salary and wages before we zeroed it out, before the credit. I'm talking about before the amount before we made this closing entry. Before we made this entry. Then once you zero out all the expense and revenue accounts, you simply close out whatever balance you have or zero out whatever balance you have in the retained earnings account. I mean, in the income summary account, sorry. So here's my income summary account. Journal entry number, closing entry number 1 was a credit for $1,550,000. Journal entry number 2 was a debit balance of $1,015,000. That left a balance of $535,000. We do one more entry to get rid of that $535,000 balance. By, in this case, crediting it to retained earnings. Okay, I'm going to end this. So you have seen the closing process. Please watch this video as often as you need to.